Take that conversation forward in greater detail, chat more about the macro setup. Maithili Bhushnamat, consulting editor, ET Now, is with us. We also have Shogato Bhattacharya, economist at Axis Bank. Welcome to the show and good afternoon. Maithili, going to start off with you. You just heard out Ruchi talking about the finance ministry officials meeting Fitch ratings representatives, pitching for a ratings upgrade. But there's so many factors at hand right now with respect to the global imbalances, what's happening to crude oil prices, elections, the overall fiscal consolidation roadmap that need to be really factored in. What is your view in terms of a case for an upgrade? Is it justified at a time like this even?
Well, I would tend to agree with Ruchi that at this particular juncture, a rating upgrade or even an outlook change to the positive looks a little difficult. But at the end of the day, let's not forget that ratings are essentially a judgment call. There is a fair amount of subjectivity involved, which is why in November last we saw Moody's giving us a rating upgrade and a change in the outlook, whereas S&P opted not to make any change at all exactly 1 week later. So at the end of the day, ratings are a judgment call with a fair amount of subjectivity. In fact, maybe more subjectivity than objectivity, which is why we are seeing that just recently, in fact the latter end of February, we saw S&P in fact grant a rating upgrade to Russia. So, and whether you want to kind of put two and two together, whether the Russian involvement, supposed alleged involvement in US elections, because remember these are all US based companies. Fitch in fact is the third of the three large rating agencies, but they're all US based. And Fitch is 80% owned by the Hearst Corporation, which is a media conglomerate based in the US. So there is a fair element of political nuances also to the rating assessment, which is why I don't expect Fitch at the moment to give us a rating upgrade. But at the end of the day, you can never say. Given the bonhomie between the present government and the US government, well, I wouldn't rule out a change to the positive side completely. But as of now, I think our fundamentals are perhaps a little worse than they were in November, even though GDP growth has improved. So I would agree with Ruchi that there is a strong case for Fitch to hold its horses at the moment, wait for the election results, and then if necessary make a change. Though of course finance ministry officials are only doing their bit. They would have to pitch to make that rating upgrade.
Thanks, Maithili, for joining us with that perspective. Let's just invite Shogato into this conversation. I believe, Shogato, you think the case is much clearer than what Maithili is saying for an upgrade. Why are you convinced that this is the right time that India deserves an upgrade? And, you know, in the past, we've actually seen the government being quite dismissive about the international sovereign ratings, saying, look at their track record and what they were giving AAA plus to in the United States before the meltdown.
Yeah, I don't think I can put it half as comprehensively as Maithili has already done. But I agree with both Maithili and Ruchi that at this point in time, a ratings outlook or a ratings, forget about a ratings upgrade and outlook, upgrade is on the cards, because I think there's too much uncertainty both in India and in offshore markets for any ratings agency. But having said that, I agree with Maithili that there are many potential problems, and which have worsened a little bit with the global commodities prices, etc. But having said this, she just mentioned the higher rating that was given to Russia and many other countries. I mean, with a similar macroeconomic environment, forget about the developed markets, even emerging markets with a similar macroeconomic environment have better ratings than India. India's Achilles heel has always been the fiscal side. So our debt levels are relatively higher, our fiscal deficit is relatively higher. But I think, I mean, the systems that the government is putting in place, we just got the reports of the DBT transfer, the direct benefit transfers, a huge amount going in via DBT, savings that are being effected through DBT. I think systems are getting put in place. And the first thing that Ruchi mentioned now with the problems that seem to be emerging in the banking sector, lack of controls, etc. I think this is a fantastic opportunity for the government of India and for the Reserve Bank of India to try to put in place more robust systems which will stand India in good stead a few months down the line, maybe a year down the line, when it comes to a relook at India's credit rating.
Sugata, you're right. The government has done a great deal, particularly by way of structural reforms. But do you think this kind of obsession, and I use the word deliberately, with quote unquote, the obsession with the ratings is a little misplaced? Because in today's world, whether it is private capital or any other kind of capital that comes in, nobody really goes by ratings. So is it more that we're looking for that pat on our back, without very much justification really, because private capital flows are certainly not driven, whether it is FDI or FII. I doubt whether private money ever looks at the ratings and invests. So is this obsession with ratings a little overdone, Sugato?
The foreign debt borrowing that we have, the external commercial borrowings that we have, maybe we'll get a slightly fairer, finer pricing than we had got. But I mean, you're completely right. I mean, that you've seen that the biggest thumbs up that foreign investors can give is showcased in a country by the currency of the country. And the Indian rupee has been one of the most remarkably stable currencies amongst the EM basket for a long time, outperformed many baskets. So you're right to a very large extent that India was already getting priced in at a ratings which was higher than what the ratings agencies had been done. But the eternal hopes, like, I mean, of course, I mean, there is a prestige element to this, that, I mean, we are a AA, single A rated country, etc. But having said this, I think the ratings, one of the ratings agencies, one of the concerns that they had is our per capita income levels, that we are relatively the ability to absorb shocks because of the low per capita incomes. And if people actually start believing the narrative of doubling farm incomes, etc., I think that's yet another narrative that will add to India's positive ratings.
Swagato, in the case of S&P, in fact, they had quoted what you said, the low level of per capita income. Now, isn't that stating the obvious? We are a poor country, we are a developing country. So to hold low per capita income as one of the reasons for not revising our rating, to my mind, seems very absurd. So do you think ultimately the rating agencies, frankly, as I said, they decide what position they're going to take and then look for reasons to justify whatever their decision is, rather than looking at the macroeconomic fundamentals and then basing their rating? Or am I being too harsh on the rating agencies? Remember, they don't have a very good track record, whether it was the 2008 crisis or any of the other subsequent crises or the earlier crises that we've seen. Rating agencies have always been behind the curve. So does one really need to look at them much more harshly and much more critically? And what explains their clout?
Well, I mean, it's not, I mean, you're completely right that, I mean, it's ratings, sovereign ratings, other ratings, company ratings are always behind the curve. The equity markets, the signals that emerge from bond markets, equity markets are much more contemporaneous relative to the developments of that company or that country or whatever, relative to what the sovereign, to the ratings agencies, the CRA's ratings gives. But having said this, that whether some of the measures that they take are not in line with what appropriate economic indicators might be, that's absolutely given. I mean, as we were talking about, I mean, many of India's contemporaries, maybe at slightly higher levels of per capita incomes, etc., but which have none of India's drivers, which are relatively more difficult to describe. I mean, the productivity drivers, the transport drivers, electricity availability, etc. So none of that is taken into account explicitly in the ratings equations. So having said this, ratings are very, very subjective. The other point that you mentioned, I mean, people also, investors also recognize, but the whole problem with the ratings is a lot of the index-driven portfolio, the automated portfolios that are given, are so intimately linked with the ratings that even a one basis point rating upgrade immediately increases weights in global portfolios, and that has, I mean, if maybe a little bit more than marginal impact on the currencies, on global capital flows.
Oh, well, yes, I was just playing devil's advocate, but Swagato, if you look at it, a rating essentially is a measure of the country's ability to repay its debt. Now, given that India does not have any sovereign debt at all, we have never borrowed internationally. Yes, there is quasi-sovereign borrowing by some of our PSUs, but the country as such has not borrowed. So, and we have never defaulted in our loans to in our repayment of our loans to any of the multilateral rating agencies. So what is a rating agency like Fitch going to measure when it gives a rating? Surely it cannot be our ability to repay, because there is no debt to repay. So what are they really measuring? What yardstick are they looking at? Purely at the macroeconomic numbers?
Again, I mean, Maithili, I mean, couldn't put this better, because I mean, this is not such a matter for the sovereign, because even quasi-sovereigns are treated pretty much like the sovereigns, and very little chance of a default, and people recognize that. Investors, global investors recognize that. What is important is because many corporate or non-sovereign debt borrowings are tied to the sovereign benchmark. And if that sovereign benchmark improves a little bit, despite the sovereign borrowings not being related to the sovereigns, that increases. And particularly now, since we will be more reliant on global capital as our growth improves, as our investment improves, our domestic capital pools are simply not strong enough to support that kind of growth. So that will increase our dependence for corporate borrowing, for non-sovereign borrowings. And that will increasingly begin to have some traction depending on what the sovereign credit ratings are. Having said this, of course, I mean, for the near term at least, I mean, global investors are completely bullish on India, which is, again, I mean, that huge discrepancy between what we ourselves in the country think and what global investors are thinking about India. Having said this, but over a longer period of time, I think that's that small connect that we have in this entire the noise that we make about the sovereign credit ratings and the potential for accessing large amounts of long-term finance that we need from the global pension funds, etc., that we will need for financing our investment once growth begins to pick up.
Okay, so with that, let's conclude this discussion. In fact, the Fitch officials are expected to enter Finance Ministry at 12:30 p.m. Stay tuned to ET Now for all of the updates. And thank you, Maithili and Shogato, for that discussion.